Hi, everyone. Welcome to today's PENTalk. We still have a few people signing in, but we're going to go ahead and get started. Today is our fourth annual installment on pensions, retirement, and markets, trends to watch in the new year. I'm Beth Parker with Pentegra. We're glad you joined us today. Before we begin, I want to go over a few housekeeping items. First, please find the control panel that is located on your screen. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we'll definitely follow up. Also on your control panel is a handout section. Here we have posted a copy of today's presentation along with an overview of the Secure Act for employers and an overview for your participants. Please feel free to download these resources now or at any point during the webinar. Let's get started. Today we're joined by Fred Slade, Assistant Vice President and Senior Director of Investments for Pentegra. Since joining us in 2007, Fred has managed over $1 billion in internal bond portfolios, has provided case liability studies, analytics, and product strategy for our defined benefit and defined contribution plans. He has also worked with others at Pentegra to help launch many new and exciting products over the years. Fred got his start at the University of Pennsylvania, where he received his bachelor's degree, his master's degree, and his PhD in economics. And as I like to say every year, when we host this PENTalk, I'm pleased to have the doctor in the house with us today. Fred, thanks for joining us and presenting. I'm going to turn it over to you. Let's get started.
Okay. Thank you, Beth, and thanks everyone for joining in on the PENTalk today. I'd like to discuss 5 key trends in the pension and investment markets for 2020. And what I'll be talking about will be the stock market, interest rates, the Fiduciary Standard, the Secure Act, and the exchange-traded funds. I'll first discuss the U.S. stock market. Just to go over what happened in 2019, after the market went down by 4.5% in 2018, as we all know, the market rebounded to a tremendous extent in 2019. The S&P 500 returned 31.5%, and that surpassed all analyst expectations and also surpassed virtually all international stock market returns. What were some of the major factors behind the 2019 turnaround? There was general optimism in the market regarding U.S. trade policy, including rollback of some tariffs on Chinese goods. So even though there were certainly ups and downs in terms of the trade war with China, overall there was general optimism. The Federal Reserve cut rates 3 times in 2019 after it had raised rates 4 times in 2018. So that certainly gave a lot of juice to the market as well, with interest rates being so low. Third, strong growth in consumer spending, which compensated for weaker business spending. So it was really the consumer that was really driving the market and driving growth in U.S. GDP. And fourth would be buybacks of company stock. A lot of companies, especially the larger ones, use their excess cash to buy back their stock, and that's certainly helped support the price per share. So that was 2019. Okay, 2020. We're a month into 2020, and the question is, are there going to be headwinds or, quote, darker clouds in 2020, which will give us a different result in the equity market than we had in 2019. First, of course, right now the coronavirus impact is front and center. From the human factor, of course, we certainly hope that this gets contained in short order. If we look at prior, virus epidemics or pandemics such as SARS, generally what we've seen is the market will get hit for the first few days. There'll be a big sell-off. Then eventually it comes back, assuming that the situation is stabilized. And that's at least over the first few days what we're seeing with the coronavirus. The market sold off by 600 points in the Dow, and then the last few days it's come back. Now, even though certainly the coronavirus is not totally stabilized by any means, and actually may get worse, but this is kind of the way the market has been with these type of impacts. Is that there may be short-term effects, but they don't play. It doesn't play a huge. It doesn't have a huge impact over longer time periods. The thing to look at, I think, is in terms of the impact of the coronavirus, is how markets are impacted. The China economy almost certainly will be weaker, and there's likely to be ripple effects across countries, including the U.S. And another thing to keep in mind is that the virus, to the extent that stores are closed down or factories are closed down in China, where, for example, most of Apple's iPhones are made, that could have a negative impact over time on company earnings, as well as economic growth. Again, we don't know at this point, but it's something to keep in mind. Now, beyond the current impact of the virus, what about 2020 with fundamentals? They may play a more fundamental role. One fundamental is the growth of the U.S. economy, and we know that economic growth in the U.S. has been slowing, even though it's still been steady. But internationally, there's been significant, flat, very, very, very slow growth in Europe, and China has also been slowing down. Manufacturing is in recession. Now, another fundamental would be corporate earnings, and earnings have been flat to declining over a year-over-year basis after double-digit growth in the prior 2 years. Now, you'd think that might have a negative impact on the market, but what we've seen is that many companies have set expectations with analysts and then beat them, and that's known as earnings surprises. So even though the earnings haven't been terribly exciting in terms of what's reported, if they beat the analysts, then the markets really like that. Also, another fundamental would be valuation multiples, especially for large cap stocks like Apple and Google, and they've been at record highs. And we would expect those to decline to more normal levels, but we can't be sure when. Now, I'm just going to diverge for a second and discuss what is a valuation multiple. Basically, the numerator of a valuation multiple is the price per share, and the denominator is either earnings per share or cash flow per share. So really, when we look at it, it's really just numbers, in an absolute sense. So, for example, the S&P priced earnings is around 21, and price per cash flow is around 12.5. Now, what does that mean? What do those numbers mean? Well, I think we have to look at history and see what those multiples were in the past. And right now, the multiples are very high, and actually at record or near record levels. And again, that could be because of low interest rates or investors just piling into growth stocks. Growth stocks have way outperformed value stocks. And also, could be tweets about tariffs. So there's been, sort of a lot of, momentum, and like I said, even investors not wanting to miss out, and those have created these very high multiples. Now, if these multiples do come down to more normal levels, then the markets will correct. But again, these multiples are extremely high levels. Other potential risk factors, of course, the 2020 U.S. election. In terms of Brexit, Brexit has become official. It became official on January 31st of this year. And tariffs continue to be questioned in terms of, there's still hundreds of millions of U.S. tariffs on Chinese goods. So that's certainly still out there. Now, what does that mean? Is that portfolio diversification is important. It's certainly important in stocks and bonds, but it's important overall to have diversification. Again, because market timing, trying to time when the market's going to correct or come back again, generally doesn't work. It's extremely difficult to time the market. Okay. All right, let's talk next about interest rates. And I'll focus here on the Treasury yield curve, even though there are trillions in corporate bonds out there, but we'll just focus now on the Treasury, U.S. Treasury. And there's a difference when you look at the yield curve. There are the short-term maturities, which are less than 1 year, and those are driven in a lot of ways by the Federal Reserve. And the Federal Reserve cut rates 3 times in 2019. They're currently on hold for 2020, but that may change certainly if the economy weakens further. The other thing is, will there be tension between the Fed and the executive? If you may remember back in 2018, there certainly was pressure coming from the White House to the Federal Reserve to cut rates. Now, the Federal Reserve is independent, so we don't know whether that'll rear its head in 2019, or I'm sorry, in 2020. Now, the other part of the yield curve would be the intermediate and long-term 1 to 30-year maturities. And there's been a significant drop in those rates, but those are really driven not so much by the Fed, but by the factors I listed below: inflation, economic growth, federal deficits, and supply and demand. Okay, let's look at something that occurred that has not occurred very often in the past, and that was an inversion of the yield curve. And if you look here, I know it's a little hard to see, but the curve that's labeled October 2019, you can see it kind of has a U shape. It starts up, then goes down, and then goes up a little bit. And what that means is that it's inverted, means that short-term rates were lower, short maturities are higher than rates in longer maturities. Okay, that's pretty unusual. You typically see something more like what you see here in December 2019, where longer rates will give you higher yields. Now, what's interesting, again, if you really, for people who look at historical data, is that an inverted yield curve, like you see in October 2019, has historically predicted a recession, but it can take anywhere from 6 months to over a year. Now, again, that may or may not happen. The probability of a U.S. recession, the consensus is well under 50%. But there was that inversion. So again, it's something that we want to keep an eye on, whether history actually repeats itself. The other thing about, probability of recession, I mean, the U.S. economy has expanded for 10 years. I mean, that's, if it's not a record, it's pretty close to a record run of positive GDP growth. So one could say, well, we've been in this cycle, is the cycle going to end at some point? So again, that's another thing that, the yield curve might be telling us. What is it meant for retiree savers who invest, a fair amount in short-term type of thing, instruments such as CDs? If you look at the average one-year CD rates, they've come down since the middle of the year, and the Federal Reserve cut interest rates 3 times during that second half. So it's not surprising to see lower rates, but they have not come down that rapidly. The average rates have come down, but not as quickly as the Federal Reserve has cut their rates. Okay, third, let's talk about trends in a fiduciary standard. And you can see here that the move toward a uniform standard was disrupted in 2018 and 2019. Okay, so in 2018, the DOL Fiduciary Standard, which was known as a conflict of interest rule, was repealed by a federal court. So it kind of threw things into some amount of turmoil, or at least, it certainly created uncertainty once that happened. So what happened is that the SEC issued its proposed best interest, or BI standards, and those were focused on broker-dealers to disclose conflicts of interest and to exercise reasonable diligence, care, skill, and prudence. And what's also happened is that a number of states have proposed their own fiduciary regulations for broker-dealers and investment advisors. And 3 of them, New York, New Jersey, and Connecticut, have proposed regulations, and they're in various states of consideration. Okay, what's the outlook? What's our outlook in 2020, or what are some things we want to think about here? The SEC BI standard is expected to become effective June 30th, 2020. The DOL is expected to repropose its standard, but its timing is uncertain. So it's really the BI standard is front and center on the federal level. So if it's adopted, although it's generally considered less strict than what the DOL had proposed in 2018, it would still strengthen protections versus the older standards. Okay. So if we go next, is that on a plan sponsor level, nothing has changed in terms of what the action items are for plan sponsors. And I'd actually put these up a year ago. If you want to download the presentation, it's available to be downloaded on the control panel. So I won't go word for word, certainly, over each of these action items. And this is only a partial list. But again, these items, certainly, remain action items for sponsors and fiduciaries. Okay, Secure Act. I'm not going to spend time on these because we have, there's been a couple of webinars done by Rich Rouser, Pete Swisher. And again, there are 2 Secure Act PDF files or slides that can be downloaded from your control panel. So again, I'm not going to go over these. As we know, some provisions are effective now, while others are delayed to 2021 or after. Okay. Last trend or trend item I'm going to talk about is exchange traded funds, or ETFs. And ETFs have exhibited tremendous growth, and growing, definitely is popular among investment advisors for rebalancing client portfolios. And what that means is that the ETFs can easily move assets between fixed income and stocks, different stock styles, different bond funds. And this sort of rebalancing can create some fairly significant volatility in the market over the short term. Okay, ETFs still are a relatively small fraction of total funds, but there's been 16% annualized growth rate over a 10-year period for ETF assets, and they were about 3.4 trillion at the end of 2018. And you can see that ETFs allow real-time pricing. They have a sector focus, and their fees have been coming down. Generally, their expense ratios are between index funds and actively managed funds. One thing to note here is in the ETF market is that generally only the largest and oldest ETFs thrive and survive. So the top three ETF providers are Vanguard, the BlackRock iShares, and the State Street Spiders. Okay. And usually, again, it becomes the survival of the fittest, and they can also offer the lowest expense ratios. And just the next slide, which just shows the growth in the net assets and number of ETFs, leveled off a little bit in 2018, but there's certainly been significant growth. And with that, that's what I have. I would also take a look at the disclaimer, since we don't forecast. We don't forecast things, but here's a disclaimer. So,
Fred, thanks for your.
That's what I have. Thank you, Beth. Okay.
Yes, I do have a couple of questions that have come in. If we can take just a minute or two to answer. First one: what are some key economic reports to focus on this year?
Yes, that's a great question, Beth. There are reports that I think we should focus on, whether it's in the news or Wall Street Journal, whatever, would certainly be the labor market. So the unemployment rate now is at 3.5%, just to track that. Job growth, how many non-farm payrolls, that are added each month or subtracted, and now those tend to be in the headlines. It's averaged about 170,000 a month added. So again, we'll have to see whether that it maintains that pace or whether that changes or not. And also consumer spending, as I had mentioned before, that the consumer has been a big part of economic growth in the U.S. It's been strong. There was a little bit of tailing off in the fourth quarter of last year, so we'd want to keep an eye on the consumer here. And then GDP growth, as I said, it's been averaging around 2% on an annualized basis. Most analysts forecasted something around 2%, some even a little bit lower, like 1.5%. So that's certainly, again, the economy, I said has been steady, but we want to see whether there might be some sort of slowdown during 2020.
Okay, good reports to focus on. One more question has come in. What are recent trends in fund expense ratios?
Yeah, it's another great question. Well, the recent trend has been really the trend over, I'd say, the last 20, 25 years, is that fund expense ratios continue to come down. There's a Morningstar study which found that on average for actively managed funds where the expense ratio was over 1% or 100 basis points in 2000, they came down to 67 basis points in 2018. And for passive, and again, this includes index funds, but also semi-passive as well, 25 basis points in 2000, 15 basis points in 2018. Now, of course, we offer in our plans, for example, the S&P 500 index, where the management fee is 1 basis point, and we look to offer the lowest fee share class in actively managed funds. So again, the short answer is that they're coming down, and they'll expect that they'll continue to come down.
All right. Well, I want to thank everybody for tuning into our PENTalk today, and I want to thank Dr. Slade for presenting, and we hope to see you on the next PENTalk. Thanks, everyone.
Thank you.